When people talk about China's economy, opinions are usually extreme. Some say it's collapsing, others say it's unstoppable. The reality, especially from an investor's point of view, is more nuanced. The first thing investors look at, long-term investors, don't focus on headlines. They focus on structure. China still has a massive manufacturing base, deep supply chain control, a highly educated workforce, strategic influence over global trade routes. Those fundamentals don't disappear overnight. Where the pressure is coming from, China is dealing with real challenges: slower population growth, property market stress, lower consumer confidence, reduced foreign investment compared to the past. From an investor's perspective, this isn't a sudden collapse, it's a transition phase. How millionaire investors actually think about this? Wealthy investors rarely ask, is China winning or losing? They ask, which sectors are shrinking? Which sectors are being protected? Where is capital still flowing? What industries align with national priorities? China continues to support areas like advanced manufacturing, technology infrastructure, energy systems, export-driven industries. That tells investors where long-term stability is being reinforced. Why China still matters globally? Even with slower growth, China remains deeply embedded in global supply chains, commodity demand, emerging market trade, manufacturing inputs worldwide. From an investment standpoint, that means China is still systematically important, even if growth rates look different than they did decades ago. What smart capital is doing right now, instead of chasing short-term rebounds, long-term investors are reducing overexposure to weak sectors, watching policy direction closely, positioning for structural shifts rather than fast gains. This is a defensive, calculated approach, not panic and not blind optimism. The key takeaway is this: China's economic future isn't about to collapse. It's about adaptation. Countries, markets, and investors all go through cycles. What matters is how capital, policy, and infrastructure realign over time. For investors, China remains a market that demands attention, but also discipline. The biggest mistake investors make is thinking in extremes. The smartest money watches transitions quietly, waits patiently, and adds when long-term signals show up, not emotions. Understanding China's economic future isn't about guessing the headlines. It's about understanding how global systems evolve with time.